Seth Holm joins me now. We're talking Chinese GDP, and this is actually interesting. Tell me about something you read in the Wall Street Journal.
That's right, Emily. This morning I want to talk about Chinese GDP and how that ties into the freight markets. So the Wall Street Journal put out a long piece this past week that I read, and everyone who follows the financial markets closely knows that Chinese economic data should be taken with a grain of salt.
Yes.
They carefully manage and watch this data. And so what the Wall Street Journal did is they put together a lot of forms of alternative data, much like we have in Sonar. Things like electricity output, things like freight and rail data, satellite imagery. And when they put all this together, they wanted to determine how fast the Chinese economy is actually growing. So let me tell you, on the reported number in the latest quarter, China is apparently growing at about a 6% rate. Now that is already the slowest rate in 30 years.
Yeah.
But the Wall Street Journal determined using the alternative data that it's really only growing at about 3%, or just about half that.
That's rather fascinating. So it's half of what they're reporting. Do you think it's because of the tariffs that's why their economy is hurting?
I do. So if you look at within that 3% number, they're actually able to manage that even poor number for them. So things like they can do forced bank lending, the state-owned banks. They can do government spending, but they can also, if you look at the manufacturing and the industrial areas of the economy, those are reportedly tracking down as much as double digits, and that's a lot of your export-oriented industries that are hurting there. So maybe this is a reason why they are softening their stance on the trade war.
It makes perfect sense. And you were talking about tying this back into the freight industry. How does their GDP tie into the freight industry?
It's really simple. Anything that stabilizes or is good for the outlook on the trade war is good for future economic growth, which is therefore good for the future outlook for freight movements.
And you were talking about them softening up a little bit. They had listed items that are no longer putting tariffs on these items. Do you think we'll continue to see that and they'll loosen even more over time?
For now.
Yeah.
So one tweet can change this in seconds, right? But for now, what they've agreed to do is they've agreed to buy some farm output, some commodities from the U.S., which was a sticking point. And they've also agreed to meet in Washington to have trade talks. So right now, the outlook is pretty good. And maybe they think, I don't know why they're doing that either, because economic growth is poor, or maybe they think that President Trump has a high chance of getting elected in 2020, so they might as well go ahead and try to strike a deal.
Like you said, though, one tweet can change everything, so definitely something we'll watch. Thanks again, Seth Holm.